Your bank may be the next bank at risk of failure. To make matters worse, the Federal Reserve probably already knows. And even worse than that, they won't tell anybody. Because if the public actually knew how much risk these banks were taking on, it would cause the very collapse they were scared of in the first place. A recent report reveals that the Federal Reserve is increasing its demands for corrective actions by regional banks, and that they have issued private warnings to a bunch of different lenders with assets in between 100 and 250 billion. This comes as a response to the bank failures that happened earlier in the year with Silicon Valley Bank, Signature Bank, First Republic Bank, and wanting to prevent something like that from happening again. Banks receiving the new warnings from the Federal Reserve include Citizens Financial Group, Fifth Third Bank Corp, M&T, and more. While we don't know the specifics of which banks received which warnings and how many other banks were included, we know that it could have something to do with the lender's capital, their liquidity, their technology, their compliance, or more. And just in case you're thinking that, man, it's a good thing the Federal Reserve is proactively looking at this so that we don't get a repeat of what happened earlier this year, don't take that victory lap yet, because as we'll see later, the Federal Reserve was already aware of the risks that the banks from earlier this year that failed had, and they did nothing about it. If you don't know who I am, my name is Joe Brown. I run Heresy Financial University, where I help active investors get high returns with less risk by learning how markets actually work. If you're interested in joining, link is in the description below. These warnings that the Federal Reserve issued are called matters requiring attention or matters requiring immediate attention, shortened to MRAs or MRIAs. Now, because of the financial system having a little bit more stress on it right now than people were aware of about a year ago, they are tightening down their scrutiny and trying to see if there is anything they can do to prevent further stress and collapse in the system. The Fed's vice chair for supervision says that they need to improve the speed, the force, and the agility of their oversight. Now, if you're a bank, you don't want to be getting one of these notices. Number one, you know you're already under stress. You're at a ton of risk. You have big unrealized losses piling up on your books. The last thing you want to do is have to tighten things up that could make it harder to deal with those losses, number one. And then number two, make it harder to make profits as well. Because when you receive one of these MRAs or these MRIAs, they can be very costly to address. And if they don't resolve these issues on the tight new deadlines, then you could also see enforcement actions. While these banks are not anywhere near the size of the big six like Chase, Bank of America, they are decently sized, being in the same size range as the three banks that failed earlier this year. As mentioned earlier, these banks include KeyCorp, Huntington, Regions, and First Citizens. Now, I'll explain in a moment why all banks are actually at risk here, but there's a particular amount of risk with this size of banks simply because they're not required to report their losses. For the largest banks, they do recognize their unrealized losses in their regulatory capital, but not for this size of banks, the category 4 banks that we're talking about here. So even if these banks have a significant pile of unrealized losses, these paper losses would not be adequately reflected in the capital ratios. Now, this is a big problem, obviously. Imagine you have two people, each with $100,000 in their brokerage accounts. And let's say they both invested in stocks in the S&P 500. Subsequently, the S&P 500 drops and they're both sitting on a 30% loss in their portfolio. One of these players is required to report that unrealized loss because they haven't sold yet, so it's still unrealized, but their equity is currently $70,000 in their portfolio. If they try and go get a loan, it would be based off the current market value of their portfolio, $70,000. While the other player is not required to report that unrealized loss because they haven't sold yet, and so they're still showing a portfolio value worth $100,000, even though today it's only worth $70,000. So that's what's going on here. Many of these mid-sized banks have no requirement to show their unrealized losses, and so it looks like like they are much healthier than they actually are. Now, you might be sitting there thinking, well, if they're not required to report it, how do we actually know that they're at a loss right now? And it's because every bank does the exact same thing, rendering every single bank insolvent. It's how banks actually work. If banks only were depository institutions, then you would leave your money with the bank and you'd have to pay them a fee to pay for the building and the salaries to keep your money safe for you. But that's not what banks do. Banks engage in something called fractional reserve banking, meaning when you give them your money, they don't just keep it there for you. They go out and they use that money to make a profit. Most of the time, they're doing something like buying US government treasuries. Treasuries are considered risk-free assets. And so if banks want to be conservative with your money, this is what they'll do. They'll just buy these treasuries. This becomes a problem though when those treasury rates were extremely low, reaching almost 0% over the last couple of years, and then subsequently surged to multi-decade highs. Because when interest rates go up, bond prices go down. So all these treasuries that all these banks bought went down in value. So if they're able to sit on these bonds and wait for them to get paid back, then sure, they'll get their principal and their interest back. But banks can't always control when they need to sell their assets. They may not be able to sit on them until maturity. This is exactly what happened with Silicon Valley Bank, First Republic Bank, Signature Bank. They were forced to sell these assets at a loss because people started requesting their deposits back. And again, this is how all banks work. And considering most banks put most of their money in treasuries, every single bank is in this situation today. Underwater, insolvent, sitting on a massive pile of unrealized losses. But Category 4 banks are not required to report these paper losses. As if to pour salt in the wound, these banks are not even offering you any interest worth noting. Right now, the average savings account earns 0.4%. So not only are they taking your money and exposing you to their risk by mismanaging your money and telling you you can come and get it at any point you want, meanwhile locking it up in something that has a loss, and if too many of you try and get your money back, they don't have it. Not only that, but they're paying you basically nothing in interest on those deposits. Meanwhile, the inflation rate running at 3% officially right now is eating away your purchasing power every single day. Because it's actually very easy to get an interest rate on your cash savings that beats the inflation rate while getting rid of that risk of banks exposing you to their risk, losing your money. So I've got a whole course coming out on that soon, how to beat inflation and get rid of that counterparty risk with your cash savings. For members, you'll automatically get access to this, and for anybody else that wants that, link is in the description below. Coming soon. By the way, guys, I'm doing a silver giveaway, hundreds of dollars worth of silver for the Silver Symposium in Vegas from September 29th through October 1st. First place prize is getting this 10-ounce silver round. It's an Australian kookaburra, beautiful 10-ounce piece here. Second place gets this 10-ounce bar, not as pretty, but still 10 ounces of silver, so hundreds of dollars here. Third place prize gets this 1-ounce silver round. It's plated with gold, and it has this nice little Bitcoin design stamped into it, so pretty cool. So what do you have to do to get the prizes? Number one, you have to sign up for the event with the ticket link in the description below. Number two, you have to meet me in person. The first person who signed up with my link, who meets me there in Vegas, gets this first place prize. Second person to meet me gets the second place prize. Third person there to meet me gets the third place prize. So get your tickets in the link below. Just a couple of weeks left. Can't wait to see you there and give away these silver prizes. But like I mentioned earlier, the fact that regulators are currently looking at these banks and saying, hey, you need to do something about all these unrealized losses and your increased risks doesn't actually share warm and fuzzy feelings with anybody looking at this, because they did the exact same thing with Silicon Valley Bank before it collapsed. Examiners at the Fed had uncovered issues with Silicon Valley Bank months earlier. Just like they're doing right now with the current banks, they issued Silicon Valley Bank MRAs and MRIAs all the way back in 2022. They had already told the bank they had to improve its process for tracking interest rate risks. Essentially what we're seeing seeing here is a systematic takedown and consolidation of the banking industry in the United States. For decades now, what we've seen is a collapse that requires a bailout, and then that bailout causes undue profits and excessive risk-taking from moral hazard, so new regulations come in to clamp down on that. But then those new regulations make it much harder to make money, causing a spillover effect in risk, and you flip-flop back between regulations and bailouts, until you get to a point where there's only 6 or 7 or 8 banks left. All the other banks have not been able to survive because they can't handle the increased costs and they have no way to make profit. This is pure consolidation and centralization of the banking system in America. And if you study monetary history, what you will notice is consolidation and centralization always leads to nationalization, because you cannot top-down control the entire financial system if there's 2,000, 3,000, 4,000 different banks. But if you can get that number down to 6 banks, well, then it's very easy to control the financial system. James Stevens, the co-leader of the financial services industry group at the Troutman Pepper firm, said there's been a very noticeable and heightened regulatory focus on anything liquidity, deposits, or funding related. He said, "I can't think of ever experiencing such an acute focus on deposits, liquidity, and funding risks, manifesting itself in a lot of rulemaking and a lot of on-site examination questions." And to toss a metaphorical grenade into a room full of TNT, we are currently seeing massive risks build up in regional banks with the commercial real estate exposure. In order to survive, smaller banks may need to pursue high-risk loans to avoid becoming zombie lenders, with delinquencies set to rise after a 30% decline in office property values and $1.5 trillion of US commercial real estate debt coming due in less than a year and a half. It is safe to say that the banking system in the United States is probably not safe, with more trouble yet to come. If you're interested in learning how to make more and lose less as an active investor, consider joining Heresy Financial University, linked in the description below. As always, thanks so much for watching. Have a great day.